For many foreign-owned companies in Vietnam, tax compliance appears straightforward on the surface. Monthly reports are submitted, invoices are issued, accounting records are maintained, and management assumes the company is operating safely. But many foreign investors are surprised when their business later becomes subject to tax inspection or deeper regulatory review. Because in Vietnam, one of the biggest triggers for tax scrutiny is not necessarily the size of the business. It is the quality and completeness of the company's records. And unfortunately, many FDI companies only realize the seriousness of documentation problems after authorities begin asking questions. One of the most important things foreign investors must understand about Vietnam's tax environment is this: compliance is heavily dependent on documentary evidence. In many situations, the issue is not whether a transaction actually occurred. The issue is whether the company can properly prove it. This means invoices, contracts, payroll records, banking documents, approvals, and supporting materials all play critical roles in demonstrating compliance. If records are incomplete, inconsistent, or poorly maintained, authorities may begin questioning whether the accounting treatment is reliable. And once that happens, the company may face deeper review through tax inspections or audits. Many foreign investors underestimate how quickly incomplete documentation can affect the credibility of the company's accounting structure. For example, expenses recorded without sufficient invoices, payments lacking supporting agreements, payroll records inconsistent with labor declarations, or banking transactions that do not clearly match accounting entries. At first, these may appear to be isolated administrative issues. But from a tax authority's perspective, weak documentation may indicate broader compliance weaknesses inside the business. And once confidence in the company's records decreases, authorities often begin reviewing additional areas more closely. This is why incomplete records frequently become the starting point for broader tax scrutiny in Vietnam. Many startups and SMEs entering Vietnam rely heavily on outsourced accounting providers. And in some cases, accounting systems are built mainly to satisfy filing deadlines rather than long-term compliance defensibility. Reports are submitted on time, but documentation management may remain weak. Contracts may not align properly with accounting treatment, and supporting evidence may not be organized systematically. As long as no inspection occurs, management assumes everything is functioning properly. But during tax inspections, authorities often review whether the records behind the filings are actually complete and defensible. This is where many foreign-owned companies encounter serious problems. Because accounting submissions alone do not guarantee compliance if the supporting records are incomplete. Foreign-owned companies in Vietnam frequently engage in cross-border transactions, management fees, software subscriptions, consulting payments, intercompany loans, or overseas service arrangements. These transactions often receive greater attention during tax inspections because they involve international financial flows. If supporting contracts are incomplete, invoices are unclear, or foreign contractor tax obligations were not properly handled, authorities may begin questioning the legitimacy or treatment of the transactions. For FDI companies, incomplete records involving overseas payments create particularly high compliance risk. Because once authorities identify documentation weaknesses in one area, they may begin expanding their review into other parts of the company's operations. Another common issue foreign investors face involves inconsistencies between payroll records, labor contracts, social insurance declarations, and personal income tax filings. In many companies, HR, payroll, and accounting functions are handled separately without sufficient coordination. Over time, inconsistencies begin accumulating quietly. Employee benefits may be treated incorrectly, allowances may not be documented properly, or contractor arrangements may lack sufficient support. These issues may remain invisible during normal operations. But during tax inspections, authorities often compare records across multiple compliance systems. And if discrepancies appear, the inspection scope may expand significantly. Imagine a foreign-owned trading company operating successfully in Vietnam for several years. The company grows steadily, revenue increases, monthly tax filings are submitted regularly, management assumes compliance is under control. But during a routine tax review, authorities request supporting documents for certain expenses and overseas payments. The company then discovers several problems. Some invoices are missing, certain contracts cannot be located, payroll records contain inconsistencies, and banking documentation does not fully align with accounting entries. What initially began as a limited request for clarification gradually evolves into a broader tax inspection. Management suddenly realizes that incomplete documentation, not intentional wrongdoing, became the trigger for deeper scrutiny. This situation is more common in Vietnam than many foreign investors realize. For foreign-owned companies in Vietnam, documentation is not simply administrative paperwork. It is part of risk management itself. Strong documentation systems help businesses support tax deductions, defend accounting treatment, reduce audit complications, maintain banking credibility, and minimize the likelihood of expanded tax scrutiny. In contrast, incomplete records create uncertainty, and uncertainty often attracts deeper review from authorities. Experienced foreign investors understand that strong compliance depends not only on filing reports, but on maintaining records capable of supporting those filings later. At LTS Law, we regularly advise foreign investors who encounter operational and legal difficulties connected to accounting, documentation, and tax compliance issues in Vietnam. Although LTS Law does not directly provide accounting or tax filing services, we help clients identify professionally assessed accounting and audit partners experienced in supporting FDI companies with stronger transparency, English communication capability, responsiveness, and practical understanding of foreign invested business operations. Because sustainable compliance requires more than submitting reports. It requires building documentation systems capable of withstanding audits, inspections, and regulatory scrutiny over time. Many foreign investors only realize the importance of documentation after authorities begin requesting records that the company cannot fully provide. But by then, correcting historical weaknesses often becomes stressful, expensive, and operationally disruptive. At LTS Law, we help foreign investors understand that strong compliance in Vietnam begins with maintaining complete, organized, and defensible records from the very beginning. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on compliance management, audit readiness, or selecting suitable accounting and audit partners, book a consultation with LTS Law. Because in Vietnam, incomplete records often create much bigger problems than investors initially expect.